How tax havens broke the global economy. There are between 21 and $32 trillion hidden in tax havens right now. To put that in perspective, that's more than the combined gross domestic product of the United States and China together. Google, a single company, moved 34 billion euros to the Bermuda Islands in just 3 years and paid exactly zero tax on that money. Zero. That money doesn't fund hospitals. It doesn't fund schools. It doesn't fund infrastructure. And 10 years after the leak known as the Panama Papers exposed this system to the entire world, in 2026, the world's super rich are still hiding more wealth than the poorest half of all humanity possesses. In this episode, I explain how that system works, who sustains it, and why you are probably paying, indirectly, the bill. Imagine you could choose which country to pay taxes in, regardless of where you actually live, work, or generate your wealth. Imagine you could move your money to a place where nobody asks questions, where the identity of a company's real owner stays hidden behind layered legal structures, and where the tax rate is literally zero. That's not a theoretical fantasy. It's the everyday reality of the tax haven system that operates completely legally in most cases within the modern global economy. This system is not marginal. It is not a phenomenon of criminal cartels hidden on remote islands, although that phenomenon also exists on a smaller scale. It's a sophisticated financial infrastructure sustained by some of the world's most respectable countries, openly used by the planet's largest corporations, and by the wealthiest individuals in human history. Let's start with the numbers, because they're hard to fully grasp. According to the Tax Justice Network organization, there are between $21 and $32 trillion hidden in tax havens worldwide. The system's own opacity complicates a more precise count, that is, literally, the system's central purpose, that nobody can know exactly how much money there is or who it really belongs to. This organization calculates this represents an annual loss for governments of approximately $480 billion. A figure similar to Austria's entire gross domestic product, lost every year, recurrently, forever. 10 years after the publication of the Panama Papers, one of the most famous journalistic leaks in history, coordinated by the International Consortium of Investigative Journalists, a report from the Oxfam organization published in April of 2026 revealed that the planet's wealthiest individuals are still hiding more than $3,055 billion in tax havens. That amount exceeds the total combined wealth of the poorest half of the entire world's population. Concentration within that system is even more extreme than the aggregate figures suggest. The wealthiest 0.1% of the world's population holds more than 80% of all undeclared assets hidden in tax havens. And the 0.01%, meaning roughly 1 in every 10,000 wealthiest people on the planet, holds nearly half of those fortunes that completely escape national tax systems, equivalent to $1,777 billion concentrated among an extraordinarily small group of individuals. To truly understand how this system operates, there's no better documented example than the structure Google used for more than a decade, technically known as the double Irish with a Dutch sandwich. The mechanism worked like this, step by step. A multinational like Google would establish a company with legal headquarters in Ireland, taking advantage of Ireland's 12.5% corporate tax rate, already well below the Eurozone average of around 30%. But the real engineering happened afterward. That Irish company would pay enormous sums of money to a second company, also of Irish nationality, but with its tax residence in the Bermuda Islands for intellectual property rights and brand usage. Since Bermuda charges no corporate tax at all, that money effectively went untaxed. And to avoid certain European withholding taxes, the money often passed first through an intermediary company in the Netherlands, hence the name Dutch sandwich. The resulting numbers are staggering. According to data published by Reuters, this structure allowed Google to save $24.5 billion in taxes during 2018 and $23 billion during 2017. In a single year, 2017, Google used this technique to move $22.7 billion to the Bermudian tax haven. And between 2016 and 2018, the company moved a cumulative total of 34 billion euros to Bermuda, where, according to its own accounts registered with the Dublin Companies Registry, It paid no corporate tax whatsoever because, quoting the company's own justification directly, the tax rate in Bermuda is 0%. To put what this means in a single country into perspective, Google reported revenue of 45,684,000,000 euros in Ireland in 1 year, of which it paid only 263 million in corporate tax, an effective real rate of 0.58%, well below even Ireland's already low nominal rate of 12.5%. Apple starred in an even more notorious case. In 2016, the European Commission determined that Ireland had given Apple such favorable tax treatment that it constituted illegal state aid, and ordered the company to repay 13 billion euros in unpaid taxes between 2003 and 2013. The case went all the way to the Court of Justice of the European Union, which in 2024 finally confirmed the decision definitively and without possibility of appeal. Apple publicly expressed its disappointment, arguing its income had already been taxed in the United States. But the ruling made clear the tax structure used for years had been specifically designed to artificially minimize the company's global tax burden. Here's the point that completely changes the conversation. Much of this system, including the Google and Apple cases we just described, was not technically illegal at the time it occurred. There is a fundamental technical difference between tax evasion, which is illegal, and tax avoidance or tax engineering, which operates within completely legitimate international legal frameworks in most jurisdictions. Tax havens favor both practices, but it's the second, legal avoidance, perfectly designed by extremely high-level tax attorney teams, that sustains most of the system at the corporate scale. A joint analysis of Google, Amazon, Facebook, and Apple, the so-called GAFA companies, revealed these four companies billed more than 280,700,000,000 euros through Ireland, Luxembourg, and the Bermuda Islands in a single fiscal period, three jurisdictions with extraordinary tax incentives specifically designed to attract this type of corporate structure. In Spain, during that same period, the four companies jointly declared an aggregate profit tax expense of barely 22.6 million euros. A practically symbolic figure considering the real size of their operations in the Spanish market, where Google and Facebook alone controlled around 80% of the digital advertising market. Google itself, under sustained pressure from the European Union and the United States, announced in 2020 the voluntary end of the double Irish with a Dutch sandwich, declaring it would simplify its corporate structure to license its intellectual property directly from the United States instead of from Bermuda. It was an implicit, though never explicit, acknowledgement of the structure that had been designed precisely for what it appeared to do: artificially minimize the company's overall tax burden, exploiting legal gaps that existed between different countries' tax systems that were never designed to operate in a coordinated way against truly global corporations. This system's impact is not distributed evenly across the planet. It hits particularly hard the countries that can least afford it economically. Latin America and the Caribbean lose approximately $12 billion every year that never reaches their national budgets, due to the financial evasion and structural weaknesses in the international tax system, according to estimates from the State of Tax Justice. Panama remains, in the 2025 Financial Secrecy Index, the only Latin American jurisdiction among the 20 most opaque in the world, while Brazil, Uruguay, and several insular Caribbean territories function as regional bridges for capital that ends up fleeing toward even more opaque jurisdictions. The Mexican case precisely illustrates the magnitude of the problem at a national level. According to Oxfam's 2026 report, Mexico's untaxed offshore wealth stands at around $59.5 billion. Of that total, the wealthiest 0.1% of the country concentrates approximately $47.6 billion. That means the foreign assets held by Mexico's wealthiest segment equal almost two-thirds of the total wealth held by the poorest half of Mexico's population, 66 million people. To put it into perspective what that money could fund if it were properly taxed, that amount would allow multiplying by more than 100 times the resources Mexico's health secretariat annually allocates to operate its 6 regional specialized hospitals. There's an additional inequality within the international tax transparency system itself worth mentioning. The automatic exchange of information mechanism, which has partially reduced untaxed offshore wealth since its implementation between 2016 and 2017, systematically excludes many low and middle-income countries from its full operation, precisely the countries that most urgently need those fiscal resources and that suffer, proportionately to their economic size, the most from evasion's accumulated consequences. The good news, if you can call it that, is that the problem is finally on the international agenda seriously, with concrete institutional mechanisms. United Nations member states approved in November of 2024 the terms of reference for a United Nations Framework Convention on International Tax Cooperation. Formal negotiations began in early 2025 and are expected to continue through 2027. It is the first serious attempt to create a truly multilateral and universal framework to combat tax evasion at a global scale, instead of leaving the issue exclusively in the hands of organizations like the Organization for Economic Cooperation and Development, where the wealthier countries have traditionally had greater influence over rule design. As of March 2026, 166 countries and jurisdictions had formally joined the Common Reporting Standard, the global framework underlying the automatic exchange of information system between tax administrations. It's a real, measurable advance, but still insufficient. The European Union updated its own list of non-cooperative tax havens in February of 2026, including new territories like the Turks and Caicos Islands and Vietnam, while removing others like Fiji, Samoa, and Trinidad and Tobago, clear evidence that the global map of financial secrecy remains dynamic, and that affected jurisdictions constantly adapt to stay off the international regulatory radar. Organizations like LatinDad propose concrete and technically well-founded measures, creating public registries of companies' beneficial owners, so it becomes impossible to hide who really owns a company. Eliminating reservations in multilateral tax cooperation agreements, so all types of taxes, not just some selected ones, become subject to automatic information exchange between countries and harmonized fees on capital outflows toward high opacity financial jurisdictions, specifically designed to directly discourage fund flight towards those territories. The tax haven system is not a historical accident or a marginal anomaly of modern capitalism. It is a financial infrastructure deliberately built over nearly a full century by some of the world's most powerful governments and financial institutions, perfected by successive generations of highly specialized tax attorneys, as demonstrated by the Google case we just examined in detail. It is not exclusively a problem of criminals laundering money on exotic islands, although that phenomenon also exists on a smaller scale. It is, above all, a largely legal system that allows those who already have more wealth to accumulate even more wealth, while the rest of society funds, with their own taxes, the public services that concentrated wealth never proportionally participates in. Every time a public hospital lacks sufficient funds, every time a school doesn't have the resources it needs, every time critical infrastructure isn't built for lack of budget, it's worth remembering that somewhere on the planet, at this exact moment, there are trillions of dollars resting in an account practically nobody can see, generating returns for someone who will probably never have to answer for them. That is not an accidental failure of the system. It is, unfortunately, the system working exactly as it was designed to work from the beginning.